Investors are naturally drawn to companies that are expanding rapidly. New factories, bold acquisitions. Surely these are the companies that'll deliver the best returns. Actually, the evidence suggests the opposite. Ben Edwards from Albion Strategic Consulting explains.
They use a metric like asset growth as an example. So companies which seem to be building their empire very, very quickly, that might not necessarily be productive spending. That's I think the crux of it is that there may be profligate spending, at which point it's not actually productive use of assets. The investment premium itself is certainly much stronger in very, very small companies, and that's where it becomes really, really important and impactful on outcomes, is actually by the time you start to take away those companies with really, really high rates of investment, they've got really, really low profits, and they're very small companies as well. If we can exclude them from the portfolios, we increase our expected returns.
This isn't just a theory, it's a finding backed by rigorous academic research, including work by Nobel laureate Eugene Fama and Kenneth French. So if the evidence is clear, why do investors keep piling into fast-growing companies?
It could have crossover to things like a growth story in effect, and growth and value. They buy into a story, there's an exciting story about the future, and they see that sort of quick, fast rate of investment is something that is going to help them achieve that at a quicker pace. The evidence suggests that that's not the case in more often than not, and actually those companies with higher rates of investment, higher asset growth, tend to underperform quite materially their peers in certainly the small cap space.
The so-called investment factor is one of several factors, small size being another, which according to financial academics have delivered higher returns over the long term than the broader market. It's fair to say it's not the most important factor, but, says Ben Edwards, it's still worth having exposure to.
It's one of a range of factors which could be considered, and it certainly passes the tests of what would be a sensible process to consider factors. In terms of its impact on the portfolio, given it's most impactful in the small cap space, if you were to list the ones that you want to start with, well, you'd probably start with the market risk factor, the fact that we want to own equities, we want to own stocks in companies because we think they're going to outperform cash over the long run. And then we might move to value and smaller companies and profitability. We probably might go down that route in that order, approaching all of them at the same time. We might also introduce investment at that point, but certainly all of those risk factors together would all pass sensible tests of what we consider to be robust risk factors.
For investors then, the message is clear. Don't be seduced by exciting growth stories. Companies that expand cautiously tend not to make the headlines, but they've generally served investors well in the past.